So let's talk about something that everyone thinks about at some point. Should you buy a home right now? And if so, where does it make more sense, USSA or India? On the surface, this seems like an easy decision. Real estate feels like the safest long-term bet. But once you start comparing prices, interest rates, and actual affordability, the story looks very different. First, affordability. In the USA, the median home price is hovering around $420,000. That's massive considering the average household income is about $75,000. Put that into perspective, the typical home costs nearly 6 times the average income. That's not only historically high, but also unsustainable for most people without stretching themselves thin. Now, compare this to India. While homes are significantly cheaper in absolute terms, say around a 50 to 70 lakh for a good property in a major city, the challenge comes when you match that against local incomes. For the average middle-class family earning, we're 10 to 15 lakh a year. And housing affordability isn't drastically better. So both countries face a similar problem. Homes are priced way ahead of incomes. Second, financing. In the US, mortgage rates have climbed above 7% in 2025, the highest in over 2 decades. That means higher monthly payments, less buying power, and fewer people qualifying for loans. On the other hand, in India, home loan rates average around 8.59%. It's higher on paper, investment. But remember, loan sizes are smaller because property values are lower. That makes the monthly EMI still manageable compared to US mortgages. Plus, Indian banks tend to lend more conservatively, which reduces risk. Third, investment value. US real estate has historically grown at around 4 or 5% per year, with hotspots like Texas, Florida, and Arizona doing much better. But with today's high interest rates, many markets are cooling and rental yields barely touch 3-4% in most places. Meanwhile, in India, rental yields are often 2-3%, which is lower. But property appreciation in Tier 1 and Tier 2 cities has been explosive in the past decade. For someone looking at growth potential, India might offer bigger upside, especially as urbanization and middle-class demand expand. Finally, lifestyle and opportunity cost. Buying a home isn't just about numbers. It's also about where you want to build your life. In the US, ownership means stability, tax benefits, and long-term wealth, but it comes with the risk of locking up capital during a high-interest environment. Renting may actually be smarter in many US cities right now. In India, owning a home carries cultural weight. It's seen as a milestone of success and security. But tying up too much capital in real estate could mean missing out on other high growth investments like stocks or startups. So investment, which makes more sense right now. If you're in the US, waiting might be the smarter play, at least until mortgage rates ease and affordability improves. Investment and renting and investing the difference could build you more wealth in the short term. In India, buying could still make sense if you're in a fast growing city and plan to hold the property long term. But even then, don't stretch yourself so far that you become house rich and cash poor. The bottom line, buying a home is less about where you live and more about how well the math works out for your personal situation. Run the numbers, compare the opportunity cost, and remember, it's not about owning a home as fast as possible. It's about owning the right home at the right time, investment under the right conditions. When people talk about buying a home, the first thing that comes up is affordability, because no matter how good an investment looks on paper, investment only works if the monthly payments line up with what you actually earn. In the United States right now, the median home price is around $420,000. Compare that with the average household income of about $75,000 a year, and you start to see the problem. Historically, housing markets were considered affordable when the price to income ratio hovered around 3 times. Today, that number has nearly doubled, which means most people are spending far more of their income just to afford a place to live. Even if you manage to save for a down payment, the monthly mortgage at current interest rates easily eats up 30 to 40% of income for many families, leaving very little room for savings, investments, or even day-to-day expenses. Investment, the gap between wages and home prices, is the biggest affordability challenge in the US market. Now look at India. On the surface, prices look much lower. A middle-class family can find a decent home in a major city for somewhere around 50-70 lakh, which sounds very affordable when converted to US dollars. But the key is to measure those prices against local incomes. If the average professional in a city like Bangalore or Delhi earns around a 10 to 15 lakh annually, the house still costs 5 to 7 times yearly earnings. That ratio is surprisingly similar to what you see in the US. Even though the absolute numbers are smaller, the financial strain relative to income feels just as heavy. Families often have to rely on multi-generational savings or help from parents to make the purchase possible. While this might reduce the pressure on mortgages, investment, it shows that affordability is not really easier in India either. It just plays out in a different way. Another point to consider is the cost of living outside of just the mortgage or loan payment. In the US, property taxes can add thousands of dollars a year to ownership costs, and insurance has spiked in states prone to hurricanes, floods, or wildfires. Investment. This makes home ownership significantly more expensive beyond just the purchase price. In India, property taxes and insurance tend to be lower, but hidden costs come through maintenance, society charges, and infrastructure issues that owners need to fix on their own. So in both countries, the sticker price of a house is only the beginning. The ongoing costs can tilt the scale of affordability even further. Affordability also has a psychological layer. In the US, many buyers feel forced to stretch their budget because renting can be just as expensive as paying a mortgage, especially in cities like Los Angeles or New York. In India, the cultural expectation of owning a home often pushes families to buy earlier than they might be financially ready for. Either way, investment, affordability is about more than just numbers. It's about how much risk people are willing to take on for the security of having their own place. And right now, whether in the US or India, affordability is under more pressure than ever, making the decision to buy a home one that requires careful planning and realistic expectations. When affordability sets the stage, investment. The next critical factor that decides whether buying a home makes sense is financing. The cost of money itself often determines whether a house is within reach or not. In the United States, mortgage rates have recently climbed above 7%, levels not seen in more than 2 decades. At first glance, 7% might not seem catastrophic, but when applied to a loan size of $350,000 or more, the monthly payment skyrockets. For example, a 30-year mortgage at 3% might cost around $400 a month, but at 7%, that same loan now demands closer to $300. That difference of nearly $100,000 per month is enough to wipe out a family's ability to save or invest. What makes the situation even more difficult is that rising rates reduce what buyers qualify for. A household that could once afford a $400,000 house now only qualifies for maybe $300,000, creating downward pressure on purchasing power even if home prices remain high. The financing challenge in the US is compounded by the requirement of a significant down payment. While some programs allow for 3 to 5% down, the most competitive loans expect 20% upfront. On a $400,000 home, that means saving $80,000 just to get started, not including closing costs and fees. For younger buyers, especially millennials and Gen Z, who are already burdened with student debt and higher living expenses, accumulating that amount of cash feels nearly impossible. Even though there are loan programs with lower requirements, they often come with higher monthly payments through insurance premiums or less favorable terms. So the structure of financing itself creates barriers even before considering whether the home price is reasonable. In India, financing looks very different, but it comes with its own set of challenges. Investment. Home loan rates average between 8.5 to 9%, which sounds higher than the US, but loan sizes are usually much smaller. A family buying a property worth a 60 lakh may only borrow 40 lakh after using savings for the down payment. On a 20-year loan, the monthly EMI may fall between $35,000 to $40,000. While this is still a big portion of monthly income, it is often considered manageable relative to Indian standards of spending. Unlike in the US, where loan approvals are often more flexible. Investment. Indian banks tend to be conservative. They carefully assess income stability, existing debt, and repayment capacity before granting loans. This cautious approach protects the financial system from widespread defaults, but can also exclude many younger or lower income buyers who may not yet have a stable credit history. Another dimension of financing is how interest rates behave over time. In the US, most homeowners lock in a 30-year fixed rate mortgage, meaning the monthly payment remains predictable for decades. Investment. This gives stability even when rates climb in the broader market. In contrast, Indian loans are often linked to floating interest rates. That means if the central bank adjusts policy rates, monthly EMIs can increase. Borrowers in India face uncertainty because a budget that feels comfortable one year can suddenly become stressful if interest rates rise by 1 or 2 percentage points. Investment. This unpredictability makes financing more risky even though the absolute loan amount is lower. There is also the cultural element of financing. In the US, debt is considered normal, and carrying a mortgage for decades is viewed as a standard part of life. In India, families often push to repay loans as quickly as possible, even making lump sum prepayments whenever extra income is available. This reduces long-term interest costs, but increases short-term financial strain. The psychology of borrowing shapes how people view homeownership, with U.S. buyers more willing to stretch out payments and Indian buyers more determined to clear their obligations early. Government policy plays a role too. In the U.S., mortgage interest can sometimes be deducted from taxable income, which softens the blow of high payments. There are also first-time buyer programs offering lower rates or assistance with down payments, investment, though competition for these benefits is fierce. In India, tax deductions are available on both principal repayment and interest payments under sections of the Income Tax Act, which provides meaningful relief for middle-class buyers. These incentives encourage more people to buy, but can also lead to households taking on loans larger than they should purely to maximize tax savings. At the core, financing reveals that the barriers to buying a home are not just about the price of the property, but about the structure of borrowing itself. In the U.S., high rates and massive loan sizes lock many buyers out of the market, even if they have decent incomes. In India, higher rates are offset by smaller loans, but the unpredictability of floating rates and the strictness of bank approvals make it difficult for certain groups to participate. In both countries, the decision to buy is heavily influenced by how much debt feels sustainable and how much financial risk families are prepared to shoulder for the security of owning a home. When analyzing whether buying a home in the United States or India makes sense, investment. The question is not just about affordability or financing, but about the long-term value of the purchase. Real estate is often viewed as an investment, and the true test of that investment comes down to appreciation, investment, rental yields, and how the property fits into an overall wealth building strategy. In the United States, the long-term average appreciation rate for real estate has been around 4 to 5% annually. May not sound like much, but when combined with the leverage of a mortgage, even modest growth translates into significant wealth over time. For example, a 300,000 property growing at 5% per year becomes nearly 500,000 in just a decade and close to 800,000 after 15 years. However, this growth is not uniform. Certain states like Texas, Florida, investment, Arizona have seen much higher appreciation driven by population inflows, job growth, and lower taxes, while other areas have stagnated or even declined. This makes U.S. investment real estate a market where location and timing matter just as much as the property itself. At the same time, rental yields in the U.S. are often underwhelming, particularly in high-demand cities. Many places only offer returns of 3 to 4% annually on rental income compared to property value, which barely covers expenses when property taxes, insurance, and maintenance are factored in. Investors in the U.S. often rely more on appreciation than rental income to justify their purchases. That means the bet is on long-term growth, not immediate cash flow. In today's environment of high mortgage rates, this becomes even more challenging as carrying costs can exceed rental income, turning an investment into a short-term loss in hopes of long-term gain. In India, the dynamic is different. Everything makes a good investment. Rent yields are generally low as well, often ranging between 2 to 3%. This means if someone is buying a home purely to rent it out, the returns might feel disappointing, especially when compared to other investments like fixed deposits or equities. However, appreciation in Indian real estate has historically been much stronger, especially in urban and semi-urban areas. Investment. Cities like Bangalore, Hyderabad, Pune, and even Tier 2 cities have experienced double-digit growth in certain periods, driven by rapid urbanization, infrastructure development, and a rising demand from a growing middle class. A property purchased for a 50 lakh a decade ago in one of these cities could easily be worth more than 1 crore today, in some cases even higher. This makes Indian real estate attractive for long-term investors who can hold through cycles and benefit from the upward trajectory of economic development. Another factor is the stability of markets. The real estate market is relatively transparent with structured legal frameworks, property rights protection, and regulated mortgage systems. This reduces risks of fraud and ensures investors can rely on a predictable environment. In India, the system has improved in recent years with reforms like RARI, Real Estate Regulation Act, which increased transparency, but challenges remain. Delays in construction, disputes over land titles, and uneven regulatory enforcement can add layers of risk. That means while appreciation potential is high, Investment. The uncertainty surrounding property transactions can make investing more complex and time-consuming. We also need to think about the opportunity cost. In the US, many investors compare real estate returns with stock market performance, where the S&P 500 has historically delivered about 7 to 10% annually. If real estate yields less, the decision becomes less about returns and more about diversification, stability, and inflation protection. In India, the stock market is also growing rapidly, but real estate carries cultural significance as a safe and tangible asset. Families often prioritize owning property as a primary form of wealth storage, sometimes even at the expense of higher return investments. This cultural mindset keeps demand strong and supports long-term appreciation even when financial logic alone might suggest other options. Another point to consider is liquidity. Selling a home in either country can take months, unlike stocks or bonds that can be liquidated quickly. In the US, market depth and professional real estate agents make selling somewhat smoother. Investment, though downturns can still freeze the market. In India, selling can be more complicated due to negotiation-driven processes and fewer standardized systems, which may lock investors in for longer than expected. Ultimately, the investment value of real estate in the US hinges on steady appreciation and the security of a regulated system, while in India it rests on high growth potential, but with added risks and lower rental yields. Investment. Both countries present opportunities, but the type of investor they suit is different. For someone seeking stable, predictable long-term growth with lower risk, US real estate is appealing. And for someone willing to navigate more uncertainty in exchange for potentially higher appreciation, India offers compelling possibilities. When deciding whether to buy a home in the United States or India, numbers and interest rates tell only part of the story. Lifestyle and opportunity cost matter just as much because purchasing a property ties up not just money, but also flexibility, freedom, investment, and the direction of your life. In the US, owning a home is often seen as a marker of stability and financial maturity. It comes with benefits like building equity, tax deductions on mortgage interest, and the psychological comfort of having a permanent place to live. But the trade-off is reduced mobility. If a career opportunity arises in another city, selling or renting out a home can be complicated and expensive. Investment. For people in fast-changing industries like technology, finance, or creative work, flexibility can be more valuable than ownership. Renting allows individuals to move wherever the opportunities are without being tied down by a mortgage or long-term financial commitment. In India, lifestyle considerations are shaped by culture as much as by finances. Owning a home is not only about security, but also about social recognition. For many families, buying a property is seen as a milestone that signals stability, success, and even respect within the community. Renting is often viewed as temporary or less prestigious, even though in purely financial terms it might sometimes make more sense. This cultural weight adds pressure on young professionals to buy earlier than they may be financially ready, sometimes leading to a situation where a large share of income is locked into loan repayments. Investment, leaving little for investments, travel, or personal growth. The opportunity cost is not just financial, but also experiential, because prioritizing a home can limit the freedom to explore other life choices. Opportunity cost becomes clearer when comparing alternative uses of money. In the US, the same down payment of $80,000 on a house could also be invested in index funds or stocks, potentially compounding at 7 to 10% annually. Over a decade, that could grow to well over $150 and sometimes outperforming home equity gains depending on the market. In India, a down payment of 20 lakh invested in equities or even a well-chosen business venture could also deliver higher returns and then property appreciation, particularly if the property is in a slower growing location. This trade-off means that buying a home is not always the most efficient way to build wealth, even though it feels like the safer choice. Lifestyle priorities also play a role in the decision. In the US, the younger generations are increasingly prioritizing experiences, travel, and flexibility over traditional milestones like buying a home early. Everything may prefer to rent in vibrant urban centers close to work and entertainment rather than commit to a suburban mortgage. In India, however, the emphasis still leans heavily toward ownership as a long-term goal, even if that means adjusting lifestyle spending to accommodate loan repayments. Families often rally together financially to support a home purchase, and which reduces individual flexibility but strengthens collective security. Tax structures also influence lifestyle choices. In the US, homeowners benefit from deductions, but this mainly applies to those who itemize their taxes and have higher incomes. For many middle-class buyers, the tax benefits are smaller than expected. In India, investment, the deductions on home loan interest and principal repayments are more widely used, encouraging ownership as a strategy not just for housing but also for tax planning. This affects how households allocate their money between consumption, savings, and investments. Beyond financial calculations, there is the question of peace of mind. Some people value the stability of knowing they will not be asked to vacate a rental property or deal with annual rent hikes. Others value the freedom of not being tied down. Investment, preferring to invest their money elsewhere while keeping their lifestyle fluid. This trade-off between stability and flexibility lies at the heart of the opportunity cost question. In the end, lifestyle and opportunity costs show that buying a home is never just a financial decision. In the US, ownership can limit career and lifestyle flexibility during a time when renting and investing may actually be smarter. In India, ownership provides social and cultural benefits, but at the cost of tying up capital that could be used more productively. The right choice depends on whether you value security over flexibility, long-term wealth storage over short-term growth, and cultural expectations over personal freedom.